Time now for Hot Picks. Today we have three global stocks that have delivered negative returns over the past year. However, our next guest argues that these fundamentally strong companies now offer an even more attractive forward rate of return. Joining us is Jason Del Vicario, portfolio manager at Hillside Wealth Management, IA Private Wealth. Great to see you, Jason. Thanks for being with us.
Thank you. Nice to see you.
All right, so let's start with how you go about choosing these companies. I understand you're looking for high quality and that are offering value. So explain how you go about searching for these kinds of companies.
Sure. So we use a number of factors in our definition of a high quality business, namely that they are founder run, founder owned. So that means that the people who either started the company or are actively involved in the management of the company own a large share of the business, such that we are confident that their interests are aligned with ours as minority shareholders. So that's number one. Number two, we're looking for businesses that have a history of producing above average and consistent returns on invested capital. So whereas most people will look at earnings per share, and that's certainly important, we look at not only earnings per share, but how much capital the company needs to deploy in order to generate those earnings. And generally, when we find companies that fit this bill, we usually find some that have a moat or a competitive advantage around their business. And that usually then gets us to digging deeper and looking deeper into the financials and the quality of the operations of the business.
Let's take a look at your hot picks here. We're going to go to Sweden, to the UK, and then to Kazakhstan. We'll start in Sweden with Evolution Gaming. This is a leader in live online casino gaming. Give us the reasons you like this.
Sure. So this company is actually the largest casino on the planet, one that we've never heard of. I think we're all familiar with Harrah's or MGM for any of us who have been to Vegas. But Evolution white labels the live online casino operations for a number of customers across the world. The reason we like them is because they are founder-run, founder-owned. They don't have any debt. They have high margins, high and consistent returns on invested capital. And particularly at this time, we see that the shares are on sale, trading at approximately 16 times earnings. They pay a nice dividend. They have been buying back shares historically. We expect them to announce another buyback here shortly. And I should note that high quality doesn't go on sale often. And I should also say that high quality doesn't usually go on sale without a reason. And so the picks that we'll be talking about today, we believe are encountering some short-term headwinds or short-term challenges. And our job, when this happens, is to determine whether or not these are short-term issues or if the long-term intrinsic value of the business has been permanently impaired. The short-term issues with Evolution Gaming are that they had a labor unrest in Georgia, where they have a number of their studios. We believe that that is short-term in nature. And that they have recently, there was an announcement by the BC Gambling Commission that their license is under review because they feel that some companies in unregulated markets have been accessing their platform in the UK. We'll note that the UK represents less than 3% of their revenues. So we think that both of these reasons are why the shares are trading down of late, representing good value. We feel that these are short-term issues that the company will overcome. And as you noted in your introduction, when the price of a high-quality predictable asset is down, that means that the forward rate of return is up. And this is why we're bringing these three in particular to you today.
Another one here is a Fever Tree, another hot pick for you. I'm just looking at their stock chart in London. It's been heading down since 2022, and that was an increased cost situation, supply chain, I guess, and so on. Why is now the time to step back in?
So Fever Tree is the premier mixer brand. They've kind of created this category. And they are number one, so they have a dominant market share and market position in every single one of their markets but one, which is Germany. Their home market being the UK. Now their largest market is the US. And as you noted, the stock has come off heavily since essentially around the pandemic, when they were hit with two issues that we believe that are beyond their control and are short-term nature. One was shipping costs. So they were producing these mixers in the UK and then distributing them across the world. So of course, when shipping costs go up, that affects their margins, profitability. And then because this is a premium product, they serve their product in glass, not can, aluminum. And glass prices also went up during the pandemic. Some of these short-term issues will work themselves out quickly. So for example, in Evolution, we might understand what the UK Gambling Commission is going to come back with in a relatively short order. And some of these other issues, like for example, with Fever-Tree, can take quarters, if not years, to work through. But of course, we're looking 10 years, 20 years down the road. And all the while, the revenues and market share of Fever-Tree continue to expand. And so we feel that the shares represent great value. And if they are able to get back to their previous margin profile, which of course we think that they're able to do, and the company is guided to this, by the way, the current levels represent excellent value for the long-term minded equity investor.
And lastly, Jason, this is a little unfair to you. We're short on time, but just a quick answer on Kaspi, the Kazakhstan fintech. This trades on the NASDAQ.
Right. In short, basically, this one fits the bill the same as Evolution and Fever-Tree. So without going through the exact same rationale, this is a founder-run, founder-owned business, no debt, high margins, consistent returns on invested capital, market share leading position, and at these levels represents excellent value with a nice dividend yield. And of course, they buy back shares regularly. So we like them as well at these levels too.